Obviously, I'm very happy to be here. It's an honor to have been, it's an honor to have been asked to speak to the opening session of this weekend. And I will also be participating someday in a discussion. I do have a number of slides that have data presented in some different ways. If you don't relate very well to that, I'm going to try to describe them, and I think you can get the message anyway. But they show some dramatic trends that have been occurring, and I think they're useful. But there are about 20 of them, so don't think they're like a million. So you don't have to panic if you don't relate to them. Although the topic for today really is the crisis of 21st century capitalism, most people have been thinking about, and I oriented my talk around the economic crisis. There are other crises happening simultaneously and not unrelated to it. There is the environmental crisis, which is very much a crisis of capitalism. As if you'd like to read about that, you're more than welcome to buy the book. One chapter of which, by the way, I don't know, I can send to Finbar, is available online. One organization asked if they could put it online. So that's on the imperative of growth. The system has to grow, or else it's really in crisis as we are now. And of course, there's a food crisis, which is being felt around the world. Started in 2008, really. Not that there wasn't hunger before that time, and it has gotten worse. By the way, when that book was written, there were 36 million people on food stamps. What was called food stamps at that time. They changed the program. Now there are, I believe it's 46 million. I have the number somewhere, but it's well over 40 million now in 2011. So there are other crises that are occurring, which I would be, not to mention, of course, the wars going on around the world, which the United States is heavily involved in, and of course the European community is too, the NATO is anyway. So I'm going to talk about the economy and the economic crisis. And it is a very difficult situation that we are in, and I mean the world. Not all countries the same, but the United States and Ireland and much of Europe are certainly in a major crisis at this point. And I don't know how much uplifting this talk will be. We can talk about that later, but the situation really is not very good. And I'd like to just show you what I mean by that, and then try to explain sort of how this happened, why it happened, and why it is so severe, and why it doesn't look like it's going to be getting better anytime soon the way they're going about it, within the system and within the way of thinking of the traditional or academic economists, or as Marx had put it, the prize fighters for capitalism. Anyway, I don't know how that got up there, but I was just flipping through slides. Let's get to the beginning here. One of the things I found kind of interesting as I was I said, well, I'm coming to Ireland, let's see what Irish unemployment looks like relative to the United States. And as you can see, really, we started, the crisis really happened almost simultaneously. Except, of course, as far as unemployment goes, it's much worse in Ireland than it is in the United States, with over 14% of the people officially unemployed, and in the United States it's about 9% now. It was up as high as 10, and it seems to have plateaued at around 9, 8.9, 9.1, around that. That represents, by the way, 14 million people that are officially unemployed. If you add to that the people who are working part-time but want full-time jobs, and you add to that the people who have stopped looking for work because they're discouraged, we're talking about 28 million people. Okay? Now, I want to put this in perspective. The total private sector in the United States has less now than 110 million jobs. There are less than 110 million people employed by private companies in the United States. Okay, there's another 20 some odd and change that are in state and local governments, and by the federal government's only about 2 million people employed. So these state and local governments are now firing teachers and all sorts of other workers, and so they're not going to be a source of new jobs, and so the new jobs are going to have to come from the private sector, but if things are going on the way they're going. But the private sector would have to produce an incredible number of jobs relative to the number it now has. Okay, so there's relatively high unemployment. This just shows you unemployment over time. And these are just different recessions going back. These are the post-World War II recessions. The gray lines are the recessions. And you can see the rates of unemployment goes up. Usually, the high point is usually reached when the recession is declared over. By the way, the recession in the United States was declared over in June of 2009. Okay? It's 2 years later, and we have the same unemployment rate. Okay, so what is officially a recession just means, when they declared it over, it just means the economy is growing. It doesn't have to be growing very fast, and not necessarily fast enough to put on new workers. So what I showed you on the last slide is really just this piece of that. But recessions have been continuous, coming every 5, 6, 7, 8, 9 years. And sometimes they seem to be happening less frequently. So one of the questions is, what's different about this? Why is this different than what happened in 2000, or what happened in 1990, 91, or what happened, what makes this different? You can't see all that much right now that is different, but I'll show you another slide that shows you how different it is. This is another one another slide which goes to the issue of how long people are unemployed. So this is the average duration of unemployment, again going back to 1948, of people who are unemployed. Okay, and you can see when they had recessions when we had recessions in the 1950s and 60s, it tended to be peak at around 15 weeks was the average time of unemployed, and then people would get jobs. And you can see what happened in the 1980s and the 90s. It seems to peak a little bit higher, maybe around 20 weeks. And here, I don't think we've reached a peak, but the last data was over 40 weeks is the average number of weeks, so almost a year people are unemployed. I understand it's about the same, that about half the people in Ireland who are unemployed have been unemployed for a year. That's what I heard today. So it's something similar to that. Okay, so, oh yes, I put in slides for myself just to stop talking about that. We have in the United States the increased hunger that I mentioned. In addition, oh yes, it's 46 million people who are receiving government food assistance. There are another 20 million are eligible but haven't applied. You have people losing their homes, millions literally. There were foreclosures filed against 3 million people in 2010. That doesn't mean they were all foreclosed, but the process was begun. It was interrupted because of the gimmickry that they found out. These companies were, I don't know if people follow this stuff, but these banks were certifying and signing and saying that they had all the documents in place, and that this person owned this house and had the mortgage on this house, and they hadn't paid the mortgage, etc. It turned out they had none of the documents. They were having just flunkies that they had hired, who knew nothing, who saw nothing, just signing these documents and sending them off to court. And so once this was found out, it put a stop to some of the foreclosures, because it was such a, the judges said, wait a second, there's a legal procedure here that you're supposed to follow. And many of the banks actually can't find the documents. I can explain why, but that's a whole other story. Okay, so there is tremendous amount of psychological damage that occurs to people when they're unemployed, and especially when they're unemployed for a long period of time. And especially now, what's happening in the United States is there's discrimination against the people that have been unemployed for a long period of time. So, and it's fairly open. I don't know if there's anything actually against the law. You can't discriminate someone on the basis of age. You can't discriminate on basis of race or sex. But I don't think there's anything that says you can't discriminate on the basis of how long they have been unemployed. And employers are saying, well, basically, we don't want people that have been out of work so long, they've lost their skills. And we'd rather hire somebody younger and newer. And that has been the argument. So the longer you're unemployed, the more difficult it becomes to get a job. And this also has its psychological ramifications. Of course, we know about the austerity that's being imposed on people. That is not only an Irish issue, it's an issue in the United States very much, with severe repercussions for people who are going to be getting, people who become unemployed now get less unemployment insurance. They are stopping a lot of the health assistance for people. There are a lot of problems, and I have a number of articles about that if you're interested. We have an unstable financial system, as you're well aware, and heard tonight apparently because one of the central bank, European Central Bank economists resigned was because of conflict of interest. I didn't know about this. But the system has not come to stability. They've been throwing money at it, government money, which means our money, your money, my money has been being thrown at this in quantities that were unimaginable before this started. And it is still a very unstable system, even in the United States, by the way. The Bank of America has announced they're going to lay off up to 40,000 people. So, and this is probably the biggest bank in the United States by amounts of money that they have at their disposal. Education is a major place where they're cutting, of course. Okay, and then there is this issue that there really is no end in sight. This graph, I think, is a fairly important one. And this is really starting at the beginning of a recession, looking at what happened to employment. So all this is negative. And when the line comes back to the zero line up there, like this is the recession that started in 1974, it took about 19 weeks to get back to the same level of employment as you had at the beginning of the recession. Okay, the same number of people employed. We're talking about actual people. This isn't percentages. It's a percent of the actual people employed, not percent of unemployment. So it took, and that was fairly typical for recessions about that time. You take about a year and a half or so, and you get back, from the beginning of the loss of jobs. There are others that were deeper, there are others that were a little more shallow, but I think 74 is being fairly typical of recessions that happened in the 1940s, 50s, 60s, and 70s. The 1983, I don't have the data on here, it took 28 weeks. 1990, it took the recession of 1990-91, it took 32 weeks. In 2001, that was the dot-com bubble in the United States, the stock bubble in the United States. It took close to 4 years, okay? A little less than 4 years, 45, excuse me, these are months. I've been saying weeks. I'm sorry. I was talking about weeks before with regard to unemployment, but here we're talking about, no, that was weeks, yes, and this is months. Okay, so here we're talking about a year and a half. Here we're talking about close to 4 years, thereabouts. And this is the most recent data that's available, which is, the last data point here is for August last month. That became available about a week ago. But what you can, and this, by the way, this increase right over here is the US has a census every 10 years. And so the government hires people to do the census. And so that's what you'd say, well, that looks kind of strange in there. Well, they hired them, and then they fired them when the census was done. So that was the 2010 census, basically, is that little blip in there, okay? So then, and this is where we are. And in November of this year, so we're just a couple of months away, it's going to be 4 years. So this is what I mean by no end in sight with regard to the working people, with regard to unemployment. It is not clear. There's no significant upward trend at this point. Okay, so how did the recession develop? I mean, how did this Great Recession, which some are starting to call a depression, how did it actually get started? But Great Recession, by the way, is being used very commonly in the standard press now to refer to this recession and to differentiate it from the previous recessions after World War II. So there are many people give all sorts of reasons for it. Well, in the United States, one of the reasons they give is the subprime mortgage crisis. people were being given loans. Basically, they call them ninja loans. Did you hear about that? That's ninja is no verifiable income, no jobs or assets. You don't have to verify anything, and we give you a loan. You know, the full value of the house. And so you had banks were literally shoveling the money out the door. This is a quote from an article in the Wall Street, not the Wall Street Journal, excuse me, the Washington Post, which is, I would say, moderate to right-wing newspaper in the United States. The Wall Street machine cranked out CDOs. Oh my God, this whole alphabet soup. But basically, these are packages of mortgages that banks were then selling. Full tilt from 2005 to 2007. It was a race against time as the accelerating delinquencies ate away at the value of these mortgage-backed securities that served as collateral for many of the deals. No one was trying to contain the erosion. Rather, the players had every incentive to get the securities that backed the deals out of their inventories. So they created as many of these so-called financial instruments as possible, these CDOs, and got them out the door and sold them. Sold them to other people, sold them to investors, got them into the federal government had or semi-federal system. And so that's one of the things that's mentioned. The other is the financial chicanery and the fraud. And certainly that happened. I saw in the Irish Times, it was today or yesterday, that Ireland is involved peripherally in the Magdoff scandal. There was an Irish bank that was a funnel of funds into Bernie Madoff, who did a pyramid scheme, basically. That's probably the biggest one on record. Basically took money in and gave money out to the early people, and then you took more and more in, and they had all these, I mean, the whole thing is definitely a fraud. So people are saying, well, there were all these frauds, and it's true, there were the frauds, but they didn't cause this. And then there's another issue which I'm going to come back to, and this is important because there is something to this on a long-term basis, and that is that because of the tremendously great increase in inequality in the United States of wealth and of income, you had a lot of people who just couldn't buy all the stuff that was being produced, and that put a drag on the economy, and that's what helped cause the crisis. And it's a real phenomenon, but that didn't cause the crisis. So if you go back far enough, you say, okay, well, what did? Really, what happens is that you have under monopoly capitalism, and which is really the capitalism that we have at this time. And what do I mean by monopoly capitalism? It really is where most of the economies are controlled by very large companies that have bought out other companies or outcompeted other companies. The 500 largest companies in the world had revenues that were equivalent to 40% of the total income of the world. That's 500 companies. That gives you some idea. There have been a few articles in the last 5 months in Monthly Review on this issue of increasing concentration of corporations. So, but what's the issue with that? Well, what happens is that as monopoly capital, that is mature capitalism, develops, the growth slows down. The growth of the economy slows down from what it was when it was much more competitive. And you really need something to shake it out of the doldrums. And I'll show you what I mean by the slowing down of the economy. So a normal business cycle, you'd say, well, companies build more and more physical plant because things are going very well, and then they overbuild and they have too much stuff to sell, and you have people can't buy it all, and you have essentially overaccumulation and overproduction, and it just has to work its way out in a recession. This is quite different what we have at this point. And it's actually something that Marx wrote about in volume 3, which is kind of interesting, where the problem really is the overaccumulation of capital and not knowing what to do with it, and not having profitable outlets for it in the real economy. And actual economists talk about the real economy, which is the economy where people actually make things or provide services where most of us exist, as opposed to the financial economy and the financial system. And so basically, it became harder and harder to make money in the real economy. We came out of World War II with a tremendous spurt of growth in the 1940s and 50s and 60s, for lots of reasons. And part of it was we had a lot of people had savings during World War II. They couldn't spend money on things they might want to buy because of the industry being used to produce goods for the war. And then you had the rebuilding of Europe and the rebuilding of Japan, where U.S. companies made out quite well in that respect. And also the Korean War was a major stimulus as well. So you have many things that kept it going, but one of the biggest ones was the automobilization of America. It's not that the automobile was first introduced after World War II. Of course it wasn't. It's much older than that. But what happened was it started to take a life almost of its own. And as people, you had mass consumption of automobiles, mass purchases of automobiles. You had the building of the interstate highway system, which was a massive undertaking. You had the development of suburbs around the cities because people had cars. They didn't have to rely on public transportation. You had all of the things that go along with it. And so you had tremendous growth associated with this. I'm only supposed to talk to 50 minutes.
You're well under.
What?
You're well under.
Good. And I don't want any time taken off because we started late, you know. I should get extra time for that, actually. Okay, so you had this tremendous spurt of growth. The economists affiliated with Monthly Review, which essentially were Paul Sweezy and my father, Harry Magdoff, and Paul Duran, who died in the 1960s, and Paul died in the early 2000s, and my father just in 2006. But basically what they were saying was stagnation is nothing you really need to explain, although I'm going to try to explain it. What you have to explain are these times when the economy really does very well. You have to try to figure out why, what it is that's actually shaking it out of this stagnation that is the norm under monopoly capital. Okay, so the idea is that there's some sort of transformative technology, or that, and in the case of the post-war era, post-World War II era, it was really the automobile, and all of the fringe issues that came up, and all of the spin-offs associated with it, which were tremendous stimulus in the economy for decades to come. Okay, well, this shows you the average rate of growth corrected for inflation of the economy by decades. This is gross domestic product, which is the total of goods and services produced in the country.
In the USA.
This is US. Everything I'm going to show you now is US. It was only that first slide I put in Ireland. Well, you can see in the 1930s, the actual average was positive. It was 1.3% rate of growth. In other words, some years the economy grew, some years the economy didn't grow. Okay, but the average was 1.3. You look at the 1940s, it's up to close to 6%. You go to the 50s, it comes down to 4. The 60s are also around 4. From 1970 to 74, also around 4. Then look what starts happening in the late 70s. It comes down to around 3.4 or 3.3 thereabouts, then around 3.1, 3.2, and then look at the last decade. It's 1.6. If you're looking for a decade to which it is closest, it's the 1930s. Okay, this is the average annual rate of growth of the gross domestic product corrected for inflation. Okay, so this has not been a good decade. It didn't just start in 2007. Officially, the recession started in the United States in December 2007. This really goes back, and it really goes back and back and back. Okay, so everything slowed down. You can see what happened to businesses in their investment in structures and equipment, which is one of the ways you get jobs. Businesses build new structures, they buy more equipment, and they employ more people. And you can see that that went down from 11, 12, 13% of the gross domestic product to down to around 8%. So you might say, well, that's only 4% or 5% of the gross domestic product, but that's a major decrease in investment, in physical plant and physical capability of doing things. This is just a reflection of the slowdown, okay? And then this is, to me, one of the more dramatic slides. This is the 10-year moving average. So each data point is the average of the previous 10 years. So that from 1960 to 1970, the private sector produced, on average, 2.5% more jobs each year, okay? Why a 10-year, use this 10-year average? Because it smooths out a lot of the ups and downs, and it makes it easier to see the patterns, okay, that emerge. There's lots of play in this, okay? So you can see that starting in the 1980s, we're starting with 2.5. This is a deep recession in the early 80s. 2.5, and it comes down to around 2%, then stays around 2%, and then look what happens around 2001. This is long before the recession of 2007, which starts only in December of 2007, which would be around here somewhere. This starts going down and down and down. And it's negative now. In other words, there are, for the last 10 years, there not only have there been no jobs, net jobs created by the private sector, but there are actually fewer jobs than there were 10 years ago. That's what this is saying here, the negative number from 2010. So this is average annual rate of growth of jobs in the private sector. This is the private sector that needs to come up with so many jobs in order to employ with so many people that we have that are unemployed. So, in the 1980s really was a major shift in the economy. Everything, as you can see, it started to slow down. And what was the response of capital? What was the response of those who controlled capital? One of the responses was to wage class warfare, basically. I don't know how else to say it. In the United States, it's like a dirty word, talk about class warfare. And of course, you know, in the United States, there's no working class. We're all middle class. Everybody's middle class in the United States. Working class is not a term that's used, you know. Even workers tend to think of themselves as middle class. What they really mean is if they have an income that is high enough to be, they think is middle class. But what happened was that there really was, when Margaret Thatcher was going in England, we had Ronald Reagan going in the United States, started to put the pressure on labor, breaking union strikes, and finding ways to squeeze more out of labor. This last recession, the recession we're in now, or the Great Recession, or the Lesser Depression, you have companies firing more and more workers, and the answer, what they tell the people who remain is, we have to do more with less. That is the mantra. You have to keep repeating that, and you should be happy you have a job. We have to do more with less. And there have been there were record profits in 2010 for many, many corporations. We'll see what the 2011 numbers are. So capital was finding ways to squeeze workers, basically, to make it more difficult for workers to get more out of them, and I'll show you the results of that. Actually, why don't we see that now? This is the percent of the wages as a percent of value added just in the manufacturing sector, okay? But this is how much went to labor of what was added to the product during the manufacturing process. And you can see it was 27% in the 1970s. And in 2005, or 2006, when this was made, it was down to 15%. Well, who was getting that extra if the value added didn't go to labor? Okay, the value added had to be going to capital. I mean, that's the other place it can go. This is after you take account for all your costs, right? So it didn't go for any increase in price of some raw materials or anything. When you look at the wages going to workers, the whole economy, this is just in manufacturing, it was about 46% of the GDP in the 1960s, 70s, and it went down, it was 52% in 1960s, and it went down to 46% currently. So the total amount in the whole economy in wages going to wage earners has gone down as a percent of the economy. And of course, profits have gone up. So this is what it looks like. This is the real, that is the growth. This is all indexed to 100. 1975 is 100. The important thing is the economy has grown quite reasonable with regard to GDP per capita over time. But look what's happened to the average income, this median, which means that 50% are higher, 50% are lower. The median household income has basically stagnated. And most of this increase, the increase that came in here, well, actually even a lot of the increase that came earlier, this is household income. So what you had was more women working, so you had more two-earner households than were previously there, and you had people working longer hours. If you look at the average wage, or the median wage, it's actually stagnant from the 1970s to the present, when corrected for inflation. Okay, this is total household income. Okay, this is just from the New York Times, that radical, I know, in the United States, this is sort of, it's almost like the newspaper of record. It's considered to be it's definitely on the liberal side, but that's not saying much nowadays. You know, in the United States, it really isn't. But this was an article from earlier this week, and this was comparing two 30-year periods, approximately, from 1947 to 1979, and then from 1980 to 2009. Where did the extra income go? And you can see in that early 30-year period, the bottom fifth got a reasonable amount, and they actually got more percentage-wise of the income than the top fifth. Okay, divided into 20, etc. But what happened in this last 30 years is that 55% of what was gained in terms of income was gained by the people up here. And of course, as you go higher and higher, it's actually, I mean, the inequality of wealth actually shows up even at higher and higher levels. The top 1%er have a lot more than the next one on the way down. So you have tremendous increase in inequality of income because of this. You have a tremendous inequality of wealth in the United States as well. The 400 richest people, so I don't know how many people are in this room, but let's say it was 100, it's less than that, I'm sure. Let's say 4 times the number of people in this room have the same amount of wealth as the 150 million people, that is the lowest half of the US population.
Say it again, please.
Okay, wealth, inequality of wealth is much more unequal, or so we say wealth distribution is much more unequal than income distribution. The 400 richest people in the United States have more wealth than the bottom 150 million. Okay, so we're talking about a huge question of inequality here. Okay, so how did this all come about? You know, so okay, so what is new? What is new really is financialization. I'm talking about new starting in the 1980s, let's say, or the late 1970s. Capital was looking for ways to invest their money, and they found it hard to invest the money and make money the old-fashioned way, which is actually making something and selling it to people, be that a service or a product. And so you have this basically money making money. You don't need anything in between. And what's his name? Michael Lewis, who wrote a book called he wrote a few interesting books, Liar's Poker. He says, you know, you can't beat that. You know, making money with money. You know, it's just, can't get any better than that. So what is financialization? It's basically when you have the increase of the financial sector, which is not just what used to be called, well, there were investment banks, there were, and then there were banks that were like saving and loan banks that took in money from individuals. You had a savings account, it was at a savings and loan bank. That was merged with the investment banks. But you also have these insurance companies where they're making a lot of their money from investing the money and borrowing money to make investments. And then you have all sorts of activities surrounding real estate, which are basically financial issues. And the mortgages and the packaging of mortgages, etc. And so the financial part of the economy Keynes described it as a little tail at the end of a dog. And now the financial system has become the dog, almost. And there's a real economy on the tail. It's not quite that, exactly that, but it's something close to that. It's become a very overwhelming influence in the economy and an important part of the economy. And a lot of it is actually making nothing whatsoever, except bets. It's gambling, and I'll talk about that. Okay, so this gives you an idea of what happened. These are as a percent of the total profits in the United States, domestic profits. Manufacturing was 50% back in the 1960s. Manufacturing is now about 10% of the total profits of the whole economy. The financial sector was about 15% in the 1960s, and it was 40% when the recession started in 2007, or this may be from 2002, this is 2005. So what's happening is, this is where you make the money, is in the financial sector. This is where to invest. And how do they do it? They create all sorts of instruments, they call them financial instruments, which are basically different types of games that you can gamble on. And you can gamble on anything. You know, there's $4 trillion a day being gambled on money, just on currency, on the world markets. $4 trillion a day. So in 3 days, or 4 days, you got the equivalent of the US economy for a year, being gambled just on whether the euro is going to go up relative to the yen or to the dollar or whatever. You could gamble on literally anything. And they were making up things that were unimaginable. In fact, they didn't even know what the hell they were making up. They would have formulas that made up all sorts of these, they call them quants. These are quantitative people, mathematicians, PhDs in physics, would make up these complex gambling positions. And literally, nobody could understand what was in them. It was all just formulas. And then they'd sell them to, wealthy people. They'd sell them to pension funds sometimes. Some public pension funds bought into these things because they were promising you a very high rate of return. So with this financialization, you had a tremendous increase in gambling, in speculation. The economy, the financial part of the economy became essentially a giant casino. So that was one part of the issue of financialization. Okay, as the financial system grew, it grew based on speculation, and it grew based on one other aspect, and that other aspect is debt. That is the way they make a lot of their money, is by loaning out money to individuals, to corporations, to the government, to whoever. Okay, so part of the tremendous increase in debt, and I'll show you this, and it's not just an issue of government debt at all. In fact, in the United States, the government debt is not that big an issue. The Republicans have made it into as if it was a major crisis, but it certainly isn't. So debt is part of the financialization, the increase in debt, because you've got to make money. So basically, it used to be maybe in the mid-2000s, I was getting 5, 6, 7 offers of credit cards every week through the mail. Okay, it was something like that. You know, they were just trying to get you to borrow money. We'll give you, borrow on this, borrow on that. Of course, it's easy to get loans on whatever you want. And so, so debt is part of the financialization. You can't separate it, this increase in debt. Okay, this was a graph that my father made, this exact graph, except he made it in 1985, and he published it, because he identified the growth of debt as a major problem. And I was taking some of the data, and in the fall of 2005, before he died, I showed it to him. I said, "Pop, do you remember when you wrote about this, the graph that you showed that was so dramatic?" And he just laughed. He said, "My God, the explosion of debt relative to the economy." This is all debt, by the way. This is personal debt, this is mortgage debt, this is corporate debt, government debt, this is the entire debt in the system. I'll show you broken down. So when he was writing about it, it was about 150% of the economy. It's down here. And he was starting about it, how it was growing very rapidly in this period, and it was. It was. This was really the beginning of a tremendous spurt of growth of debt. So this is debt relative to the economy. So it peaked at over 350% of the economy. In other words, 350% of the gross domestic product, which right now is about $14 trillion, so multiply that by 3.5, is debt that is owed by people, corporations, governments, etc. So there's no magic limit, but it's only common sense that the increase in debt that there is in a society relative to the economy, the more fragile the whole system becomes. There's no magic limit, but obviously it becomes more difficult to deal with. Okay, so you have this explosion of debt, which is part of this financialization process, okay? Because that's where they're making their money. Oh yes, so this is just broken down. So you can see the debt. It's kind of interesting. Look at the financial business is down here. They hardly have any debt. But look up there. They now are the largest holders of money. You'd say, but my God, you just told us they were making loans. Yes, but they're borrowing money to make bets. They would borrow $30 for every dollar of their own they were putting in to make a bet. If the bet went bad, you not only lost the $1, you lost the other 30. Okay, so there were 30 to 1. They called it leveraging. You would because the way leveraging works is if your bet wins, you get an amazing percent increase on your money that you put in on that $1. Of course, if the bet goes sour, it's a different story.
Who was doing that, individuals or government?
Mainly governments. No, excuse me.
Yeah.
These were financial companies that were doing this. They were financial institutions. These were the big banks that were doing this. These were hedge funds were doing it too. They would take your money and invest it. If you had enough, and you had to have like $1 million or something like that to invest, so they didn't want to deal with you. But they would also borrow money and make their own bets. Okay, one of these hedge funds lost $5 billion, which was half of the money they had, on one bet. Okay, you know what the bet was? The bet was on the price, the difference between the price of natural gas in March and April of 2006. They bet the spread was going to go, there's no question that it was going to go down from March to April at the end of the heating season. But they bet one way, that it was going to get larger or it was going to get smaller, and it went the other way. And they were so highly leveraged that they lost $5 billion on that one bet, and they basically went out of business. But that's the kind of insanity that was going on with regard, I mean, there is no rational justification. There is no economic justification for most of the financial aspects of the economy that developed. It was just developed as a way to make money for some people. And a lot of pension funds, by the way, put money into these aspects as well. Okay, well, why is this issue of debt so important? Because one of the major drivers of the economy, even though the economy has been going relatively slow, has been debt creation. Okay? Why does debt drive the economy? Because if you have to save up money to buy a car, or save up money to, is there a farm animal in the audience?
My apologies.
Well, that's okay. That's okay. I've got 4 cows, 7 cows walking around up at my land. Hopefully not getting into trouble right now. So debt, because you can buy things that you wouldn't otherwise have bought if you have a credit card. A lot of people weren't paying off their credit card debt, what they owed at the end of the month. And if you could get a car loan very easily. So you could buy things that you wouldn't otherwise be able to buy if you didn't have increasing levels of debt. And so this is a stimulation to the economy. And when the government does it, it also stimulates the economy. They're not taking money out of
your pocket, that is through taxes and spending it. They're taking it by increasing the debt level and spending it. So they're taking out loans and they're spending it. And the spending of it creates some jobs, sometimes more, sometimes less. Depends on what they spend it on. And so the debt is a major aspect in what has kept the economy going. That is, growing debt has been a major aspect. So anyway, that's financial. But look at household debt. It also grew tremendously to about the equivalent of the gross domestic product. So $14 trillion. This is not only mortgages, but also credit cards. And now, by the way, student debt. There is more student debt in the United States, $1 trillion, than there is credit card debt in the United States. Because so many students have had to take out loans to go to university and to go to graduate school. So you've had a tremendous increase in this. So the average student now leaves the university with a $25,000 debt that they have to pay. And I know one person, the son of a friend who had a $50,000. I've heard of people, especially of people who go into medicine or other aspects, well over $100,000. So look at a non-financial business, which was a good part of the story. They borrow money in order to make something, you know, whatever it was. It may have been a good product or a lousy product, but they become less of an issue. There's still a lot of debt. A lot of that is, I can get into. The federal government, what happens in the last few years, it grows enough in debt, more or less, to make up for the decrease in debt of the financial sector and the household sector, so that has sort of plateaued off the debt relative to the economy. The state and local governments are a relatively small part of this picture. So here's the financial system, which is creating debt. Itself owes an incredible amount of money, okay, if you take it all together. And a lot of the business debt, the non-financial business debt, is also created by the financial system. Companies would, private capital, would buy up companies. They called it buy it, strip it, flip it. That was the terminology. You buy a company, you strip it. How do you strip it? You take on loans for that company, okay? And then you pay yourselves a fat fee and return on capital, it's called, and then you sell the company. And so you now have a company which before was very solvent, now is basically insolvent. And they're able to find people who will buy it, and they actually make a profit on this deal. But they load the company up with debt in the process. This is part of this whole process of what was going on. So why is this crisis so severe? Okay. Let me just read you something that was written after the 1987 stock market crash in the United States by my father and Paul Sweezy. But you may ask, won't the powers that be step into the breach again and abort the crisis before it gets a chance to run its course? Which is basically throwing money. Yes, certainly. That was my, the basically throwing money was mine. My father and Paul wrote much nicer than that. By now, it is standard operating procedure, and it cannot be excluded that it will succeed in the same ambiguous sense that it did after the 1987 stock market crash. If so, we will have the whole process to go through again on a more elevated and more precarious level. But sooner or later, next time or further down the road, it will not succeed. We will then be in a new situation as unprecedented as the conditions from which it will have emerged. And this is what has happened. In essence, what you've had have been a delay of a major crisis for many, many decades by governments stepping in. I'm talking now specifically of the United States, by the government stepping in every time there was a crisis. And throwing money at banks, throwing money at corporations, and resolving the crisis through increasing deficit. And increasing debt in the economy. And so, in essence, a day of reckoning was just put off and off and off into the future. But it looks like we're here. That this is the day of reckoning. And
Just a gentleman, you're in credit 5 minutes.
5 minutes? My goodness. Oh, I think I can do something. These are just some of the crises. These aren't them all. But just to give you some idea of what was going on, even in 1970, we started having some crises, but the stock market crash of '87, this was a major one, the savings and loan crisis. I think we're still paying that off, although maybe it's been paid off by taxes. The government put in it was well over 100 million, but I've forgotten. Excuse